Excellent. We'll get started. Thank you all for joining us today. I'll be your host for the session. There's a really wonderful sentence, so thank you all for coming, and we've got lots of expertise on the call today. Here we'll be talking about property tax specifically for investors and landlords. So please let me introduce everybody as we go. There's 5 people listed. There's 4 of us live on the call. We will be taking lots of questions and answers and hopefully being able to talk about some of the case specific points towards the end. And we have had a couple of queries already via email, which is great. So to introduce Colin Saville, he's not on the call, but is part of the recorded session in the middle of this seminar, where we've covered off a case study and Colin is acting as our client meeting. He is an insolvency manager, so really good for looking at getting out of limited companies in a solvent manner. You've got myself as your host. My name is Zoe Taylor. I'm a financial advisor and wealth management consultant. We also have Ben here today, Director and Tax Specialist at Smailes Goldie, Paul Mounce, Head of the Private Client Team and Partner at Goschalk Solicitors, and also Ruth, who is our special guest today, who is representing the NRLA, the Landlords Association. I invited her out here because, as a landlord myself, I've found membership particularly beneficial, and I'm sure some of you will also be members. But just as a very quick roundup of all the fantastic things they've got to offer, just to kick us off, I shall hand over to Ruth.
Thank you very much, Zoe. Hello, everyone. I'm the regional representative for Yorkshire and Humberside. My name's Ruth Millington, and I'm just going to explain to you about the role of the NRLA and the benefits of being a member. If you could turn the next slide, Zoe, please. In terms of the NRLA, we're the UK's largest member organisation for private residential landlords, and we cover both England and Wales. Originally, we were 2 separate companies, the NLA and the RLA, and we merged over the summer, essentially, to form a stronger voice. And it was also a pooling of resources. At the moment now, we've got over 88,000 landlords and growing. And as well as it's enabled us, this merger has enabled the NRLA to increase in terms of its policy team, its helpline, etc., all beneficial for you landlords. Now, in terms of landlords, the portfolios vary. So sometimes we have landlords which just own 1 property, and then we've got much bigger landlords, some who run huge businesses up to say 1,500 properties. So the type of landlords do vary. Some do have mixed portfolios of residential and commercial, and some are holiday lets. But in terms of our work currently at the NRLA, we purely focus on residential property. Now, as you're probably aware, between the last 3 to 5 years, there's been huge regulatory and legal challenges and changes. And in terms of being a landlord, you're looking at over 100 acts of parliament and 400 sets of regulations governing the private residential sector. So it's a very huge area to look at, and it's something that the NRLA can help landlords with. If you could take the next slide, please. One of the other roles of the NRLA is lobbying and campaigning the government. So we've done major campaigns such as on the Green Homes Grant, coronavirus. We've currently got a campaign in place which has just been launched today, looking at increasing housing benefit, which has been reduced recently by the government, and also providing additional loans so that it can actually support tenants and landlords during this very difficult time. We've also campaigned with the government on the possession reform section, which, as most of you all know, the Section 21 is being got rid of. Whilst we did campaign heavily for that to be stopped, unfortunately we didn't. The government was just very set on going forward on that. But what instead we have done is been advising the government on Section 8 and the different areas in which landlords should be able to get possession and advising and so forth. We also look at local and central government issues. So, for example, mandatory and selective licensing. And we will look at those on a case-by-case basis to see whether they do actually work in the particular area and they're fair for landlords and both tenants. So again, it's something that we'll look at and campaign for or against. If you could do the next slide. Now, there's lots of benefits of membership. So, for example, we have an advice line. If you do join, you can call as many times as you want. It's open between Monday to Friday, 9 till 6, and also a Saturday morning. And you can also send in your written questions online. It's manned by people who are landlords. They have huge experience in the field, and many are legally qualified. So great advice going forward, and they can put you in touch with organisations as well, and so forth. We have lots of training programs which are either done in the classroom when we don't have a pandemic on. We have e-classroom learning and different webinars and self-study. So, for example, at the moment, we've got a weekly national webinars on, which are getting specialist speakers in. In terms of training, it will go from actually buying your property up to getting tenants in and self-managing the properties, looking at all the regulations. Now, all these trainings and programs there are discounts available for members, and they're large discounts actually. So again, it's a massive benefit. And also, by doing these courses, you can get NRLA accreditation and CPD points, which is very beneficial, particularly if you're marketing your property and you want to stand out from the rest of the crowd. As we know, there's a huge, there can be very negative press against landlords. So if you've got something extra to show and to advertise, then you will attract more tenants, and hopefully good tenants as well. Next slide, please. Other benefits of membership, that we have a huge online library, and these include all legal documents, forms, and guides to pre-tenancy, creating a tenancy, managing it, and ending it. So it goes literally from start to finish. We've also got landlord starter packs, and there's information about licensing and local government, energy efficiency, and tax. And on top of that, there's regular updates, not just on the AST, but on possession and coronavirus, legislative updates on, for example, on the tenant fee ban and the new electrical safety inspections. And there's advice as well on things like the minimum energy efficiency standards and all the other legislative changes which come into place constantly, which a lot of you be aware is changing all the time. Next slide, please. One of the unique selling points that we do have is not just that we hold national and local webinars with guest speakers, which during pandemic times we've had to really sort of move towards that. But under normal circumstances, we hold local meetings. Now, I cover the Yorkshire and Humberside area, and I will hold 2 to 3 meetings in different areas, in different places around the particular region. We've got representatives running the length and breadth of the country, including Wales, and they all hold local meetings. So we will give, for example, legislative updates and inform you of new changes which you need to be made aware of. We do invite guest speakers to come in on topical issues. And it's also important because it creates a network for landlords to meet other landlords and to chat and find out about the market as well. So again, it's a very good tool and part of the membership to actually help you as a landlord. We've also got a new website, which is the feedback we've had, it's much more easier to move around. And this website, for example, lists all external resources, for example, helplines, government links, utilities, and deposits. So the website is essentially a go-to link and help resource for landlords who need to get in touch with various different things. Next slide, please. There's lots more benefits as well. So we have a monthly property magazine, which is sent out to members. There's lots of NRA in newsletters with updates coming out. Part of the membership as well offers free tax investigation. This is becoming ever more of an issue for landlords, and it will probably more so now because of the coronavirus, and government will have to look at some way of paying back the debt, and they'll look at if there is any taxation issues going on with landlords as well. So that is a real issue. You get your membership card, and there's also major discounts on services that are offered and covering insurance and mortgages and all the rest that are mentioned there. So again, lots of discounts available. Next slide, please. So for example, the upcoming webinars, my next one, I just held one last night actually, but the next one is the 26th of January, and in February I'll be holding one on the 16th of February, and then also on the 2nd of March. So for example, on the 2nd of March we're having the police speak about issues affecting landlords, and there's going to be a series of talks coming out from the police, which is always very interesting. The amount it costs, essentially it's £75 a year for a single membership. That single membership includes you and someone else, and also there is a business membership which will take up to 5 individuals. That's great if you're running quite a large business. In terms of discounts, if you do wish to join, do quote my discount code of 138. That will get you a £10 discount on the joining price. But if you do go onto our website, there's a link there to join, and it will ask for the discount code. So if you do decide to join, 138. Thanks very much.
Okay, so I'm just going to navigate us into the recorded session. So hopefully everyone will be able to see that quite clearly. We've pre-recorded a bit of a case study, so we're talking all about things to do with incorporation into a limited company, managing portfolios. So I shall kick off. Any problems, please just give me a shout. Thank you. Well, hello and welcome to today's seminar. My name is Zoe Taylor. I'm a financial advisor, and today I have pulled together some amazing professionals here to talk about everything to do with landlords, specifically about incorporating into a limited company. We all are very experienced, and it's wonderful to have this level of expertise here. So with that in mind, I'd like to introduce today's speakers. We have Colin Saville here, who is the insolvency manager at Chamberlain & Co. They deal with often solvent insolvency, getting out of companies, and he is here today playing the role of our client. We also have Ben joining us from Smailes Goldie Accountants. He's a tax specialist and partner there, and Paul from Goshchok Solicitors, head of the private client team. So we'll be looking a little bit about the common problems, and one of the things I get asked a lot is whether buy-to-let properties are still worth it. So we'll be looking at incorporating into a limited company and what that means. There's lots of changes lately to discourage, or that have been seen to discourage, ownership from the government. Even though we are still seeing lots of buy-to-let landlords, there's approximately 2.66 million in the UK currently, which sounds a lot, but is actually a 7-year low. However, it's not stopping the number of properties. We're just seeing less landlords, but with more properties, getting bigger portfolios, and a sign that it's very much becoming a profession as opposed to a one-off or short-term investment. Now, a few of the changes that we mentioned happened a couple of years ago now, but we're only starting to really see the impact on clients and their profits. Things such as the wear and tear allowance that used to be just a given has now gone. Additional stamp duty on second or additional multiple properties. Mortgage interest, this is a big problem that is really coming to fruition now, where people have really noticed that their profits are much lower than they used to be. And I know Ben will be talking a little bit more about this and potential opportunities to mitigate that. We're looking at capital gains tax as well, which has become more of a problem. More of it due much quicker within 30 days now, and less allowances. And of course, the government are thinking of a big reform in this area as well, which we'll be looking at. And we've also seen lots more tight restrictions on borrowing as well. So lots of things going on in the landlord space, and lots of reasons why people are really starting to think about their ownership structure and the use of trusts and limited companies as opposed to holding these properties privately. So lots going on. And within today's seminar, we hope to address certain questions such as, should I use a trust or limited company? As I've heard, I'll pay less tax. There's lots of conflicting advice online, and people in the pub, etc., that we've all come across who everyone has an opinion. So we'll be talking about the pros and cons and the things that are really pertinent and will affect you with regard to that. Also touching upon inheritance tax, because it is a big issue and we know it's quite difficult with properties to mitigate that. The illiquid nature and the manner of holdings can be quite tricky. Finally, we'll be looking at limited companies. How do I effectively sell down, get out or retire? And a little bit on capital gains tax as well. So, rather than just talking to you all about the endless rules and regulations that aren't very relevant to your own circumstances, we thought it'd be much better to bring to life in a case study something a little bit more realistic, a bit more tangible, that really demonstrates the difference. So to do that, I would like to introduce Colin as our client, who will be calling Mr. Trump for the purposes of today's case. So without further ado, lovely to meet you, Mr. Trump.
Morning, Zoe.
Good morning. Thank you very much for coming in to see me. I wanted just to kick things off, if you could give me a little bit more detail about yourself, please.
Yes, well, I'm 74, although of course I don't look it. My wife is quite a bit younger than me. She's 50. We have one child together who's barren, aged 14. And I have 3 children from a previous marriage. They're Donald Jr., Ivanka and Eric.
Wonderful, thank you. That's great. And I understand from our very brief conversation before this that you're a higher rate taxpayer from your substantial portfolio?
Yes, that's correct. I've currently got 30 properties worth together about £5 million. I bought them for around 1.5 million in total, and there is 1.6 million outstanding on the various mortgages. I also have a stocks and shares portfolio worth £3.5 million that cost me originally approximately £1.2 million.
Gosh, you've been busy. That's great, thank you. So now we know a little bit about your situation. Tell me what's your, have you got any concerns? What's going on?
I'm no longer getting a full tax deduction for the interest paid on mortgages, so my net profits have dropped substantially. A friend of mine told me to look into putting the properties into a limited company.
Right, I see. No, that makes absolute sense to me. I think you're quite involved, aren't you, with the company? You do a lot of the manual work, and Mrs. Trump does a lot of the rental side of things. Is that correct?
That's correct, yes.
Yeah. Okay, that's not a problem. We'll certainly be able to look at the tax deduction as well. Any other concerns?
I'd like to consider some state and inheritance tax planning, please, as I'm keen to pass as much of my estate to my family as possible.
Yeah, no, absolutely. That makes sense to me. Any other things you'd like to talk about today?
Well, in general, I'm concerned about my family. Donald Jr. is engaged to a lady who I believe is a gold digger, Ivanka. Ivanka is married and with 2 children, and Eric is still finding his way in life.
Yeah.
I can leave everything to Mrs. Trump without there being an inheritance bill on my death, but I'm a little concerned that she may remarry after I die and not pass on part of the family wealth to my children.
Yeah, it is a big concern, and I do come across a lot of these sort of blended families that have changed. The dynamics are quite difficult, and it can be quite sensitive to deal with. So certainly an element of post-death planning can be created to help making sure that your estate passes and gets distributed as per your wishes. So we can certainly look at that. I think where we'll begin is to start with the taxation implications of company incorporation, because that's one of the key things that you mentioned there. And to do that, I'm going to pass on to Ben, who is our tax specialist.
Thanks, Zoe. So as you've both alluded to already, one of the main reasons why a property incorporation is quite a hot topic these days is because of the restriction to higher rate tax relief for the interest paid on mortgages. So prior to 6 April 2017, higher and additional rate taxpayers did obtain a full tax deduction for the mortgage interest paid. That led to a lot of what were called casual landlords, who were higher rate taxpayers, usually by virtue of their other income. They'd buy rental properties with high levels of borrowings and obtain a full deduction for the interest paid. So in a tax raid, the government changed the taxation of landlords to restrict the tax relief available on the interest from being a full tax deduction to just being a basic rate tax deduction. So just to give you an example of the application of the restriction, this example here is lifted from the .gov UK website and looks at John, who's got self-employment income of £35,000 per year, rental income of £18,000 per year, and his mortgage interest is £8,000 per year. And on the left-hand side, you've got the position before 6 April 2017, so you can see his rental profits coming in with a full tax deduction for the finance costs there of £8,000, reducing the rental profit with the other rental costs to give a net profit of £8,000. So added together with his self-employment income of £35,000, his total tax due would have been £6,400. Looking at the position post 6 April 2020, when the full restriction does apply, this example does consider the tax bands back in 1617, just for a comparison. But you can see that the finance costs have gone from being a deduction against the rental income to instead becoming on the bottom line of the computation as a credit against the tax due. So you can just see there that the £8,000 is as a credit given at 20%. So the tax credit equals £1,600. And overall, comparing the 1617 computation with the current computation, the tax exposure has increased by £1,600. So why consider an incorporation? Well, one of the main benefits is that the company pays a flat rate of 19% corporation tax on its rental profits, and it'll get a full restriction for the mortgage interest paid. So just give you a typical example of how that benefit works. If you had an individual landlord realising £100,000 rental profit, you'll see from the computation here that his total income tax exposure going through the tax bands was £27,500. If that same profit was realised within a company, the company would pay just £19,000 corporation tax. So you've got an annual saving there of £8,500. That annual saving, if you didn't extract it to pay to the shareholders, you could use it to either roll up to repay the company borrowings much faster than had you been an individual landlord, or to save towards a deposit for another rental property. But if you were to extract it as a shareholder, you would then be exposed to income tax on that profit extraction, subject to your marginal rate of income tax.
So are there any downsides to holding my property in a company?
Well, there's the additional compliance burden. If you were to hold the property through a company is required to complete and file accounts with Companies House, as well as corporation tax returns of HMRC. But the main downside to holding the property portfolio through a company is that there's an element of double taxation on the sale of assets. If an individual landlord realises a capital gain on a sale of an asset, he pays capital gains tax, and then the net sale proceeds are his to spend as he wants. If you realise the same capital gain in a company, the company would first pay corporation tax on the sale of that asset, and then the shareholder is likely to also be exposed to income tax on extraction of the net sale proceeds. So again, just looking at a typical sort of scenario here on the table, if we had an individual landlord realising a capital gain of £100,000, he'd have his annual exemption to deduct from that capital gain, with the balance then likely tax at 28%. So total capital gains tax exposure here of £24,556. If that same capital gain was realised within a company, the company would pay £19,000 corporation tax. And then with the net sale proceeds, the company, if it were to distribute those to the shareholders, they'd likely be exposed to income tax on that distribution. And if they're a basic rate taxpayer, they'd pay around £6,000 on that extraction. If they're a higher rate taxpayer, that goes up to £26,000, and if they're an additional rate taxpayer, that increases to £30,000. So you can see there the effect that has on the net sale proceeds in the hands of the shareholder on that profit extraction, subject to whether or not they were a basic rate taxpayer all the way up to additional rate taxpayer. So a difference ranging from £519 up to £25,000.
Okay, so what would happen on the transfer of my rental businesses to a company?
Well, when you transfer the property to a company, two things happen. Firstly, you're treated as making a market value capital disposal for capital gains tax purposes. So the market value of the proceeds, less your base cost, is charged capital gains tax. The company is also treated as giving you consideration in the form of shares in the company equal to the market value of the properties. That consideration, although it's not cash consideration, is still taxed for the purposes of stamp duty land tax. So it does also crystallise a charge to SDLT. But there are reliefs available to mitigate the exposure to capital gains tax and stamp duty land tax. But what's important is that when you transfer the property to a company, you're transferring a rental business back to both capital gains tax and SDLT. But then there's a further step to get the full SDLT relief on transferring the business to a company, and that is that the business is being transferred from a family partnership, i.e. husband and wife or parents and children. If you had, say, two unrelated partners in the business, i.e. two friends who were landlords, both running their business together, on the incorporation of that partnership into a company, you wouldn't obtain full relief for the stamp duty land tax charge. So just to elaborate on the capital gains tax exposure on the on transferring the property to a company, the company is deemed to acquire the properties at the market value on the date of incorporation, because it gives consideration to the landlord in the form of shares. So it has paid for acquiring those properties. So it's only the future growth and value of the properties that is exposed to corporation tax in the company when the company sells the property. So you'll see here from this graph that, if a property was acquired for £40,000 and sold at £150,000, if the properties were transferred to a company when it was worth £100,000, it's only the difference in value between 100 and 150 that's exposed to the company's corporation tax exposure, and the unrealised gain by the landlord for the period of ownership where the property accrued appreciating value from 40,000 to 100,000 is then rolled over into the shares. So for the corporation tax incorporation relief to apply in full, there's quite a sort of dangerous pitfall here. So the relief works by rolling over the unrealised capital gain into the net market value of the shares that the landlord then acquires on the incorporation. If the unrealised gains are worth in excess of the net value of the business, full relief isn't available, so the difference in value is charged capital gains tax. So just again, looking typically at an example here, if the rental portfolio was worth £3 million and was acquired for £1 million, the landlord's unrealised capital gain is £2 million. If they had net borrowings against that portfolio of £1.6 million, the net business value is £1.4 million. So when you're looking at the landlord's capital gains tax rollover computation, there's a £2 million gain to roll over, but only £1.4 million of net business value. It's about a £600,000 difference is exposed to capital gains tax, and if that was at a 28% rate, then the total exposure would be £168,000.
Okay, well,
So
I have a rental business, so I presume I qualify for the reliefs.
Well, prior to 2013, it was commonly agreed between HMRC as well as the practice industry that a rental business was not a business for tax purposes, and that's because the rental business gave off rental income, which was treated as investment income. But in 2013, there was a tax case, Ramsey versus HMRC, and in that tax case, the taxpayer was able to demonstrate that their rental business was substantial enough whereby it wasn't a passive holding of investments, but an actively managed investment business. So the judge agreed with the taxpayer to give the capital gains tax incorporation relief on transferring that business to a company. And in doing so, set out 5 factors as to when they consider that a business does exist for tax purposes. So those 5 factors are detailed here, but essentially all that is required is to be able to demonstrate that the landlord does have an actively managed portfolio of properties. So in looking at that, has a landlord acquired 1 or 2 properties as an investment, or are they going full steam to grow a full rental portfolio? So as you mentioned earlier, you've got a rental portfolio of 30 properties.
Yeah.
So you've got a significant number of properties there whereby you should be able to demonstrate that you have got a lot of time involved in managing that portfolio. You did also mention that you are responsible for servicing those properties. So again, that would strengthen your argument that you do have an actively managed portfolio. We'd also look at if there's any kind of a business plan. It doesn't have to be documented, but some kind of minutes of meetings would be useful, just to demonstrate that you do have a serious undertaking for the business. You'd also look at whether or not you've got a significant level of turnover that could be used to service properties or used to reinvest into more properties, but also to reward your efforts for managing that portfolio. In the relevant tax case, the taxpayer was able to demonstrate that their portfolio was actively managed because they were working for at least 20 hours in managing their portfolio, and they were able to demonstrate that. So it's really important for you to get the relief, so you're doing to demonstrate that you do have an actively managed portfolio.
Okay, so seeing as we've got a solicitor with us today, what do I need to do in terms of the practicalities of transferring the properties into the company?
Yes. Well, I think it just needs to be aware that the transfer does involve a lot of transfers of properties, and as such, particularly with yourself having a borrowing against a number of those properties, it's really important from day one to work out what is required, particularly by the borrowers, the lenders of your properties, which I don't know, maybe more than one different company. Some lenders will be willing to allow the transfer relatively straightforwardly, particularly if it's one lender and quite a new portfolio that you have with them. Other lenders or a group of lenders may require a local search for each property, may require a valuation, even a formal visit valuation rather than a desktop valuation. And of course, each of those things can cost a couple of £100 each per time, per property, which can soon add to the cost and time taken. Also, on top of that, you have to consider the rates that the lenders may want to charge, as there may have to be a review of your rates and the costs involved in transfer. All that being said, though, as I'm sure Ben will confirm, the idea of this is to reduce your costs going forward significantly. And so it's quite often helpful to have an idea before you start of what the likely cost is going to be and how long it's going to take you as a landlord to recover that difference in the savings that you're going to make. there are other benefits as well, which I'm sure Ben will talk about in terms of inheritance tax planning. But it's important at the start to get all of that in the process to begin with, so you're aware of what's going to be involved.
The process of transferring the portfolio to a company, prior to 2017. So the process from 2017 will be for the tax advisor to approach HMRC to obtain a tax clearance, to confirm that the incorporation leads were available on the incorporation of that rental business into a company. But since the changes to the taxation of landlords in 2017 with respect to the interest deduction and also the 2013 tax case, HMRC were inundated with clearance applications, whereby in December 17, January 18, they just dropped back, said that they would no longer give clearance whether or not a business did exist for tax purposes. So it does create quite a bit of uncertainty now as to whether or not a business does exist on incorporation of a rental business into a company. So the best thing that you can do would be to approach tax counsel and ask their opinion whether or not your business is sufficient enough to demonstrate that you do have a business for tax purposes. Looking at your case, based on what you said, it does look like it'd be a safe bet. But even so, if you did want a bit of peace of mind, you could obtain that tax counsel opinion, so that if HMRC were looking for another test case and came knocking on your door, you could waive that counsel opinion at them, such that they might want to go pick a fight with somebody else. And then beyond that, you could also obtain insurance, whereby a sort of insurance provider would insure against the potential capital gains tax and SDLT costs on transferring the business to a company. And then once you was happy that either you had the counsel opinion or insurance to cover the exposure on incorporation, you would then need to approach the banker to get them on board with valuation specialists, approach a lawyer to draft the company articles on the incorporation, and to also transfer the documents whereby the business could be transferred as a going concern. Again, that's important for the capital gains tax incorporation leave, that your business is transferred as a going concern. And then the accountants would then be involved to draft accounts for the period to incorporation. That would also be reflected in the documentation prepared by the lawyers. So once that is all done, the structure that you end up with looks like this, whereby you've got, in your case, husband and wife owning the shares in the company. You've got the bank involved with borrowings and the rental portfolio below the company. So the company receives the rental income charged at 19% corporation tax. You as the shareholder directors can decide as and when you distribute those profits, but as and when you do, you'll be charged for income tax on that profit extraction. But once you do have a structure like this, it's quite easy to use this, quite akin to what's called a family investment company, which, whilst it's quite a sort of buzz phrase coined by professionals, it essentially is just a company used to hold family investments, but to issue shares around the family or to a trust, whereby you can divert income on those shares to the children, or you can divert the current or future capital on those shares for the benefit of the children. Again, that could be directly or via a trust. But just on the latter point, to divert the capital, it's quite a useful tool, especially if you do have assets in there that are going to grow in value, or if the borrowings are going to get repaid, such that the net value of the company will increase, because you can allocate the future growth in value to the shares held for the benefit of the children, and to restrict the growth in value held by you and your wife. So that has the benefit of freezing the value of those assets in your estates, so it no longer, as the asset appreciates in value, it will impact the IHT exposure of your estate.
Okay, so what about getting surplus profits out of the company?
Well, this is where I can come in. We all work together quite holistically. So one of the things that we can look at is profit extraction for limited companies. And believe it or not, one of the best ways of doing this is actually via pensions. Now, these sometimes have a bit of stigma attached from days gone by, but as of 2015, a lot of changes happened to the legislation and have made them much more flexible and in a lot of cases much more attractive. So major things such as no requirement anymore to access them by age 75. This was a big problem previously because it made it much more difficult to pass assets down via pensions. However, this is no longer a thing. You can hold these pensions quite comfortably until death, and lots of people do now do so. So pensions are becoming less and less accessed and more utilised for family planning for inheritance tax purposes because they are naturally exempt. So whatever funds you have in a pension wrapper, they do not class towards the 40% inheritance tax charge. There's also full tax relief going in, depending which method. So personal pensions, if you're a higher rate taxpayer like Colin and make a personal contribution, it'll only cost you £60 to get £100 in your pension, and so on. So the tax relief is very attractive, although there is another way of doing it via a limited company, which I'll show you an example of in just a moment. Another big benefit now is that they can be flexibly accessed. So we have a new range of much more generous opportunities to access. Historically, it was a case of tax-free cash and annuity. This is no longer the case. We have drawdown, phased drawdown, and something called UFPLS, which is uncrystallised funds pension lump sum. All of these essentially mean that you can flexibly take ad hoc withdrawals, you can amend your level of income, you can do all kinds of weird and wonderful things throughout retirement to provide the income you require. But as I say, most people do just hold these now until death to pass on to their beneficiaries. And when you do so, you can actually pay the funds into an asset preservation trust. Now, I know Paul later on is going to touch a lot more about trusts and how effective these can be for passing funds on. But essentially, the Asset Preservation Trust is designed to do just that. It's designed to designate trustees who can manage funds and dish it out appropriately to your beneficiaries in a manner that they believe you would have done. So if it's things like a first home, for example, that would be absolutely great. But if you've said to not give it to your 18-year-old to go to Magaluf, then they've got trustees in place who can help control that. So it also works wonderfully well for if beneficiaries get divorced, become bankrupt, go into long-term care, and a whole range of other reasons that could potentially give a bit more control for them sort of situations. And a final point on pensions to note as well, if you go for a self-invested personal pension, also known as a SIP, these pension wrappers can be used to hold a much wider, broader range of assets, and one of which is commercial property. So often for landlords who have a keen interest in property, one of the things with a SIP is you can buy your own commercial premises, for example, to run a business out of. You can pay your rent directly into your pension with full tax relief. So that's become quite a popular thing in recent years. I mentioned I would give you an example. So this is how it works for a limited company. So let's say you've set up your property portfolio and you have existing profits in the company and you wish to get them out. You've already taken all the salary and dividends you require. You can consider using employer pension contributions. So this is a combination of carry forward rules. Typically we have a £40,000 allowance to pay into a pension every year. However, as an employer, you can use carry forward rules to bring back the previous 3 tax years plus the current tax year and invest £160,000 into a personal pension, assuming you have all the available allowances and also that you've previously had a UK pension scheme in place and meet what they call wholly and exclusively criteria, which is that it can be deemed appropriate as purposes of the business of trade, which often pension contributions are very rarely challenged by the HMRC. If you did so, benefits include corporation tax relief. So this is a 19% as an allowable expense from the company, saving just over £30,000. Also, as I mentioned, as soon as it hits the pension, it's instantly exempt from inheritance tax. So no 7-year wait, no gifting, full control and access, and immediate inheritance tax benefits. And accessible currently from age 55, or this does go up to age 57 in 2028. But it does a range of things, profits out of the company, free of inheritance tax, free of income tax, free of capital gains tax, all grows in a lovely tax efficient environment with full control and access required.
Okay, well, company incorporation sounds interesting, and I can see a range of potential benefits, including using pensions to extract the profits. But it does also sound like it might be quite complex and expensive. So are there any other options for me to pass my properties to my family whilst paying less inheritance tax?
Well, I'll pick that one up for you, Colin. And yes, I think company incorporation isn't for everybody. As you mentioned, it can be complex. As Ben mentioned, there are also reporting rules that some people may wish to avoid. More importantly, of course, there are some landlords who perhaps have smaller portfolios where some of the reliefs that Ben described aren't available. And so there could be quite a large tax charge for placing those properties into a company. So for various reasons, company incorporation may not be for you. Also, as Ben mentioned, while there are some inheritance tax advantages in the initial transfer into the property, a company incorporation is primarily in relation to capital gains tax and income tax savings. And it's mainly the growth in those shares that can be taken out from an inheritance tax perspective. What you may want to do is try and get some of those properties out of your estate earlier and remove them from your estate for an inheritance tax perspective. And you can do this, although there are some rather large downsides potentially that need to be considered. You may have heard of something called the 7-year rule, which a lot of our clients will talk to us about. The technical name is a potentially exempt transfer, or a PET. And the reason it's called that is for 7 years it's potentially exempt. And if you manage to survive for 7 years at the end of that period, it's exempt. Simple as that. If it's passed to an individual, the amount that you can gift is unlimited. And at the end of that 7-year period, that amount leaves your estate completely for inheritance tax purposes. If you want to make those gifts into a trust, and I'll talk about the advantages and disadvantages of trusts in a little while, but because from an inheritance tax perspective, the advantages of a trust are much more, the amount that you can gift into a trust tax-free is limited to £325,000 for yourself, or £650,000 for yourself and Mrs. Trump. If you make a gift into a trust that is more than that value, there will be an immediate charge to inheritance tax of 20%, although that's 50% of the full inheritance tax amount, which would be 40% on death. So how do you make this gift? Very simple. You transfer the property to your chosen beneficiaries. There's no stamp duty, because in the case of a gift, there's no consideration, providing there's no mortgage and your children aren't agreeing to take on that mortgage for you. However, the big downside that you can find is capital gains tax. Even though you're not accepting any payment from your children, there will be a capital gain if the value and the market value at the time that you transfer the gift is more than your acquisition value when the property was purchased. I don't know about yourself, but for a lot of landlords, they do have a tendency to purchase properties and rent them for a number of years, which can lead to some rather large gains. This has been made even more difficult in that previously you were able to pay your capital gains tax in your following year's tax return. The problem now is that all capital gains tax has to be paid within 30 days of transfer. Of course, if you're gifting properties to your children, you're not going to have any cash available from that sale to pay your capital gain. And so you have to be able to have the capital gains tax available on transfer.
So is there any way that I can reduce or avoid the capital gains tax?
Yes, there are ways that you can mitigate when and how the capital gains tax is paid. Firstly, you and Mrs. Trump will both have an annual allowance, which is currently £12,600 each for the current tax year. And so what you can do is stagger the transfers over different tax years, do it over a period of years in order to make full use of your allowances. Of course, each time you wait, you are increasing the 7-year timeline for that particular gift. So a calculation should be made as to whether it's worth waiting the extra period of time to save a certain amount of capital gains. I suppose as well, separating the transfers out over the period of each tax year, if you are going to transfer more than one, also means from a cash flow perspective, you have a bit more time to pay the capital gains. I think for me though, probably if you are going to take this route, it's very important on day one to look at each of your properties and do a capital gains tax calculation. Because you obtain a capital gains tax uplift on your death, in other words, when you pass away, all of the properties that you own at that time are transferred at their value at that date, not when you purchase them. You have to be very careful that you don't end up paying almost as much capital gains tax to transfer a property as you are saving on inheritance tax. And to give you an example, if you had a property that was purchased for £20,000 and was valued at £120,000, the gain, if you're a higher rate taxpayer, may be around £20,000 to £30,000. The inheritance tax saving you're making is £48,000 on that particular property. However, if you die within the 7 years, having paid the capital gains tax, you still then have to pay the inheritance tax. So I think it's important to look at each property. It's much better to perhaps gift a property that you purchased for £300,000 and is now worth £350,000, because the capital gains you would have to pay is much lower, but the inheritance tax saving is much higher. So there are things you can do to try and mitigate or limit the capital gains tax exposure while reducing the inheritance tax. I believe, Zoe, if there is a capital gains tax, you may have some very clever ways to reduce that even further.
Absolutely. Sometimes, despite our best efforts, capital gains tax bills are unavoidable. There's on occasion, there's just nothing else you can do. So if you have compromised to a capital gains tax bill, there are certain things you can do, and one of which is a reinvestment of part of the sales proceeds into an investment that offers particular reliefs. So these are known as EIS schemes, or enterprise investment schemes. They're only available or really recommended to quite sophisticated people who have been relatively experienced in either companies or property or investments, because they are a higher level of risk in order to get a higher potential reward. So things like you can reclaim 30% of a previous year's income tax bill. You get this relief from the outset, which can be quite massive. And I'll show you some examples of this later on. Whilst the funds are invested in the IS, it goes free of capital gains tax. You can also have the potential to gain some inheritance tax relief as well. So it's a bit of a triple whammy on this one. And of course, we're talking capital gains tax. So this is about deferring the bill. And I'll show you how we can do that with these investments. So essentially, this is investment into AIM shares. So this is alternative investment market shares. So this is not investment into the FTSE. These are into things that either the government deem a sensible thing or want to promote investment in, all very heavily regulated, as you would imagine, by the HMRC. So some examples of current schemes that are ongoing are things like technology companies. One of the recent success stories was a part for an electric car, and some of the tracking systems that work with the Google and smart cars as well. So this kind of thing, alongside what historically was a lot of green energy and that sort of investment as well. So things that the government want to promote as such. So the way that these work are, let's assume you have a capital gains arising from selling a property, and it's £50,000 in total, which means you'll have a £14,000 bill. And let's assume as well that you've paid in excess of £15,000 income tax last year. What you can do is roll over some of the proceeds. So you reinvest 50,000 from the proceeds of that sale into an EIS product. You instantly reclaim 30%, so that's 15,000 income tax paid the year before. Now, as I mentioned, these are AIM shares, so they are smaller companies who have less trading records, who have less sort of proven dividends than anything that we would offer sort of on the FTSE. So that 30% from the upfront often helps mitigate what will probably be a relatively high level of volatility throughout the term of the investment. You can also then use this to defer the 14,000 capital gains via the EIS investment. So in practical terms, now they've changed it to a 30-day capital gains tax payment. This often means you have to pay the CGT and then reclaim it on your tax return. It's a bit of a faff, however. It does mean ultimately that with this investment, the gain is deferred, which means the bill can be paid later. So reasons for doing this would be either that you've used your annual exemption that Paul mentioned, and if you roll it over a few years, you can then utilise a future year's exemption so that you get rid of that problem. Or what is popular with these is that people keep them until death, and effectively the CGT expires. If you do continue to hold them and you still have the shares invested upon death, they can qualify for business relief. So this is an inheritance tax relief whereby these AIM shares, essentially, although they're part of the calculation still for other things like the residence nil rate band, they're still technically in your estate and they're still accessible, so they're under your control. However, we no longer count them within the actual calculation as a chargeable at 40%. So, assuming you keep on holding them, that 50,000 investment retained until death has saved 14,000 capital gains tax, 15,000 income tax, and ultimately as well 20,000 inheritance tax, which means that for a small proportion of your estate to do a job, if you like, to claim these reliefs as a small proportion, it makes absolute sense for even less experienced investors to do something that just takes a little bit more risk, potentially a lot more reward. While we're on the subject of inheritance tax, there are various things you can do. Investing into products that can benefit from that business relief, as we've seen, is one strategy. We've also touched upon gifting and the potential exempt transfers. We've touched on trust planning as well, although I know Paul has got a lot more to talk to you about trust planning and various IHT exemptions. But probably the most crucial thing to have in place at this point is a will. So I'll hand over to Paul.
Colin, one of the things that you mentioned was you had some concerns relating to preserving the family assets after your death.
Yes.
The first step in doing this is your will. Now, for most families, the starting point would be a will that leaves their estate to their spouse, and then after both spouses have passed away, onto the children, which is absolutely fine, and in most cases doesn't cause any problems whatsoever. However, in your case, I know that you have children from a previous marriage, and whenever you have stepchildren, step-parents, there is always the potential for friction and sometimes going above that, problems. Of course, on top of that, Mrs. Trump, I'm sure, wouldn't be able to find anyone anywhere near your level, but may decide in her lonely dotage that she was to remarry. And unfortunately, if she were to remarry, regardless of any will that you'd made together, that will would become void, and she would automatically, unless she made another will, effectively leave all of her estate, or the vast majority of her estate, to her new husband. Okay. Mm-hmm. There is a type of will called a mutual will, whereby yourself and Mrs. Trump could make wills together, could decide what you want to happen, how you want the estate to be passed after both of you have died, and whoever of you dies first, the survivor is effectively locked in to that will. However, the problems with a mutual will quite often outweigh the benefits, in that although you can lock the will in, it's very difficult to lock the use of the assets in. And so the surviving spouse is free to deal with those assets. And it's okay having a will that can't be changed, but if by the time you get to that will, none of those assets are still there, doesn't really help. And also from the perspective of Mrs. Trump, who I'm sure you want to look after should you part this world first, it makes her life very difficult in terms of how she can deal with assets. What I would suggest, and what I think is a very good idea to create a balance, is a flexible life interest trust. Sounds very posh, but effectively what it means is that you're allowing certain assets within your estate to be left on trust, allowing Mrs. Trump to access the income from those assets, but allowing the capital of those assets to remain in your estate until after Mrs. Trump's death, where they will then pass on to your chosen beneficiaries, who I assume would be your children.
Yeah.
This can be done for any different type of assets. A lot of clients will keep out the main residence. They will want that to pass to the surviving spouse, so that surviving spouse has that asset to themselves. In terms of your jointly owned properties, your share of those properties can be included in that trust, as long as you change them to be held as tenants in common, which means that both you and Mrs. Trump each own a separate half of the property that can be passed directly under your will. So concentrating on your residential portfolio, if you were to die first, Mrs. Trump would have ownership of her half of the property. She would also have the income from your half of the property, but she wouldn't necessarily be able to utilize the capital from your halves of the property, leaving them there for your children after her death. In addition to this, you can add a power for the trustees to release capital to Mrs. Trump if the income that you've provided isn't sufficient for the lifestyle that you have allowed her to become accustomed to.
So I've heard about discretionary trusts. What are they?
So discretionary trusts would come about on perhaps after both of your deaths, Mr. and Mrs. yours and Mrs. Trump's death. When we said that after Mrs. Trump's death, the money would pass directly to your children, that's fine. And in your case, each of your children would be very well looked after by the amount, hopefully, that we've arranged for them to obtain. However, I remember at the start of the meeting when you spoke with Zoe, you mentioned that there are concerns about each of your children. So in Donald Jr.'s case, perhaps you're a little bit dubious of his partner's motives and why, that she's with him, and perhaps it's to try and get her hands on some of the Trump family fortune.
Yes.
While Ivanka's currently, I assume, happily married, there is always, of course, the prospect of divorce. And you mentioned that she has children of her own, and I'm sure she wants to start planning for their future as well. And with Eric, we're not quite sure what's going on with Eric. We don't know where he's going to be in the next few years. We don't know what business he's going to go into. What a discretionary trust does is it gives you the ability to leave your estate into a trust and appoint trustees who can manage where that money goes and when it goes. So in other words, if Ivanka is going through a divorce, the trustees of the trust can hold back her inheritance while the divorce is going through. If we feel that Donald's partner is particularly concerning in the way that she is behaving around the inheritance, we can hold back, and the trustees can decide to only pay money out as and when they feel it's appropriate to do so. And with Eric, it just gives us that bit of time to give him time, give us time to see how he proceeds. And over and above all that, there is another benefit, which is inheritance tax. If you leave your estate directly to your children after Mrs. Trump has passed away as well, then while the tax on your estate remains the same, each of your children now inherits a large proportion of funds which, when added to their estate, might provide them with their own inheritance tax problem. If in your will you create a discretionary trust, what you have is a pot that, while your children can take the funds out immediately, the money can also be left in that pot. And if indeed it's left in the pot, or the majority of it is left in that pot for the rest of their lives, when it comes to passing the assets on to their children, there won't be any further inheritance tax on their estate because the assets remain part of the trust.
Well, that sounds good. Now, what about lasting powers of attorney? I've heard about those. What do they do?
Yes, so this is another part of the jigsaw, if you like. This is to protect against something happening to you or Mrs. Trump during your lifetime, which affects your capacity, your mental capacity, or even your physical capacity. There are two types of powers of attorney. The one I'll concentrate on today is property and finance, because that's what we're talking about. You have to have mental capacity to prepare it. So it's not something that you can, or Mrs. Trump could come to me and say, Mr. Trump's finally lost capacity. We've seen how he's been behaving over the last few weeks, and we think he's finally lost the plot, and so we need you to create a power of attorney. I'd have to say, I'm sorry, it's too late, and there is another way through the courts, but it's much more complicated and much more expensive. So this is a preventative measure. It's something you put in place while you have the capacity to do so. And once in place and registered with the court, it allows your chosen attorneys to effectively deal with any financial assets that you have. That would include properties, your main residence, your shares, and even the shares in the property company that we've talked about incorporating with Ben and Zoe. And it gives them the right, effectively, to do anything that you would be able to do, always in your best interest. Although, of course, it's very important that you choose the correct attorneys to manage this for you, and allowing them to do essentially anything that you would be able to do, which would include selling properties, would include paying dividends, would include selling shares, and everything else in between. And why it's called the lasting power of attorney, because even if after registration with the court you lose capacity, the power that you've provided lasts, and it allows your chosen attorneys to carry on looking after your affairs even after you aren't able to give them instruction.
Excellent. I hope everybody found that of interest. We did cover quite a lot during that recording, so hopefully there will be a little bit of something for everybody involved. I have opened the chat facility or the Q&A, so if anyone's got any questions, please feel free to pop them into there. I've put on the link that was missing from earlier as well into the chat page, so hopefully you'll be able to pick that up and sort out the membership if you so wish. We did have a couple of questions sent in prior to today's webinar, so I shall just go through them whilst we hopefully get some more questions from yourselves onto the chat or the Q&A. And I think mainly, of course, with the current situation and lots of fears about where the government is going to recoup the funds spent over this very dramatic pandemic, will be a lot of concerns about capital gains tax and what the future might hold for inheritance tax as well. So if one of our panellists would like to perhaps jump in and offer any help.
Yeah, thanks, Zoe. So the Office of Tax Simplification did release a report earlier this month, last month, in fact, November, regarding the reform to capital gains tax. And one thing they did suggest as part of one of their recommendations is that the rate of capital gains tax is aligned with income tax. It's just a recommendation by the Office of Tax Simplification. The government doesn't have to act on that recommendation, but with them trying to consider how to recoup some of these costs for COVID-19, you can imagine that capital gains tax, the rate of, is one thing that they will go after.
Absolutely. It might be a quite substantial amount of time before we actually see any changes to things.
I think if I can just jump in as well, Zoe, one of the other changes mooted was, at the moment, if you retain property, we talked about transferring it in the recording, but if you retain property on your death, excuse me, I've got a interloper for driving past, on your death, you have an uplift. So if you pass a property to your children on your death, any gain that's been incurred over the years is effectively cancelled, and your children would inherit that at the value at the date of your death. One of the proposals is that if your estate is not liable to inheritance tax, which of course the idea of today's session is to make sure it isn't, that the capital gain would effectively be rolled over to your children. So rather than having the uplift, if they were to decide to sell the property after your death, they would have to pay the capital gains tax from the date that it was purchased. Particularly problematic, of course, again, as we discussed, for a landlord who has had a property for a number of years, realised quite a large gain and was hoping to reduce that by passing it on death. So that's another thing to look out for, I think, going forward.
Yeah, absolutely. Thanks, Paul. I'll just check the chat facilities. Any more? Or any of our panelists want to share any other hints and tips before we sign off? You'll see on the screen that there's everybody's contact details. So if there's something that you want to discuss that's relevant to your own personal circumstances, as these things often are, please feel free to get in touch with anybody if you want a little bit more information or clarification of how this looks within your own life and personal circumstances. We're all more than happy to help. I think that will conclude today. Thank you all very much for joining us, and we'll look forward to speaking to you soon. Thank you.